Welcome to the upstreamlife.com, and I'm your host and founder, Vishal Krishna. A couple of weeks ago, I spoke with Geeta Goyal of the Dell Foundation and Pravash Dash of Arthan Finance to understand how they supported entrepreneurs or how they continue to support nano entrepreneurs. Continuing on that segment and setting the context for this podcast, I have with me Vineet Sukumar, founder and CEO of Vivriti Capital. A little bit about Vineet. Vineet graduated from IIT Kharagpur in 2001 and graduated from IIM Bengaluru in 2003, or should I say IIM Bangalore. He had a long corporate career before he started up. He founded Vivriti Capital in 2017 and founded Cred Avenue in 2020. Vivriti is a marketplace for financial services, and Cred Avenue is a marketplace for debt. Let's find out everything about him and the two companies that he set up. Vineet, well, a pleasure to have you on board and a lot to discuss today.
Thank you for having me, Vishal.
Just want to know about yourself, right? You come from such great pedigree. I mean, you finished IIT straight away into IIM, something that people take at least a decade to complete, right? How did you manage that? What inspired you to do that? Let's start with the easier questions first.
You're right. I think, in fact, one of my regrets is not to have taken some time off between my engineering and management studies, because that usually gives a lot more perspective to people. But I was in a hurry. I jumped from one to the other and had a 6-year packed period of learning. I can't complain because you get the best peer group in the world.
Absolutely.
In organizations like these, and you end up learning more from the peer group than from professors, frankly. Although I shouldn't be saying that.
But that's the truth. I would say the same about everything that I did in academics. Right? It is your peer group that teaches you. It's also the network. So how was that experience? A quick 6 years and then straight away into the corporate world?
That's right. So I graduated from my management studies in 2003 and jumped right into the Tata Group, the largest industrial house that the country had at the time. And that was a phenomenal experience that I had, because the Tata Group gave me an unparalleled opportunity to work across 6 of their companies over a dizzying 3-year period. So I could work across their businesses in auto, communications, in technology, in steel, in hotels, in beverages and tea, and a very, very rich experience in those years. Before I narrowed down to finance as an area that I wanted to really, really specialize in and do better in, and I switched from the Tata Group to Standard Chartered. This was in their corporate, institutional, and investment banking teams in Bombay, where I spent another 5 years in really cutting my teeth on my understanding of finance, on credit, on distribution, on product development, on client management, on operations, etc., etc., etc. That was, I think, the first, I would say, 8 years of my career.
The interesting part is you said finance, right? What piqued your interest at that point of time? Did you like the way capital markets were functioning? Is that the reason you suddenly decided, okay, look, I need to focus on a segment where alternative investments are important to understand? Did that pique your interest at the time?
I'll be candid and say that sometimes the choice of career is not just about what you're good at, but what you're not good at as well. So sometimes you need to eliminate what you don't do well and narrow down to what you do well. And it seemed to me that at least my interests were much higher in the field of finance. And I could play a fairly good role in understanding balance sheets, understanding how corporates worked, how money moved, and make my career in that field. Right. I also feel that there's a lot of luck in this. The luck quotient was that when I joined Stanchart, I was extremely surprised to hear that the account I would manage would be the Tatas, which really helped me because I had really understood the group very well during my 3 years there. So some luck, some chance, some good sense, I would say.
Okay, talking about chances, why did you decide to start up in 2017? I mean, just like, did it happen just because you'd seen enough of the corporate world and decided, look, now is the time to go experiment with my thought processes? Because I really want to understand the structure around Vivriti, right? It has three companies. It has, Cred Avenue, it has Vivriti Capital, and there's one more asset management company, correct?
That's correct. We have three companies. Vivriti Capital is a holding company. There are two subsidiaries. One is Vivriti Asset Management, and the other is Cred Avenue. And I'll spend some more time on these. But to come back to your first question on why take the plunge,
Yeah,
uh,
please.
frankly, I think the move I took in 2010 was, to my mind, much riskier because that's when I jumped into my first startup, not my own. I was probably employee number 10 in a company called IFMR Capital. This was part of a group that was founded by Nachiket Moore of ex-ICICI fame. And I joined this company in 2010 at an 80% pay cut, right? And that was scary. The world was just coming out of the subprime crisis,
ISIS.
and it
Yes.
seemed to be a very odd time for someone like me to take a plunge of this kind. But having said that, I think that experience was extremely fulfilling for me. The venture that I joined became very successful over the next 7 to 8 years, making a name for itself in Indian financial markets, genuinely meeting a core need of the Indian financial system, building risk appetite for capital market investors in the lower rated segments of NBFCs and financial institutions, and allowing us to take many smaller companies to scale over that period. So extremely rich and fulfilling. And I think from there, for me to take a step towards starting my own venture in 2017 was seemed almost like a natural progression. So yeah, I think when I started in 2017, when I decided to reboot and restart, the objective was to carry forward from what I had done in the preceding 15 odd years, which was to understand credit, discover a new part of the market, bring it towards global financial markets, co-opt much larger pools of capital to follow our lead in understanding a new market and build it up.
This is
And
interesting. You also called it a marketplace. I remember at the time, if I read the early news reports, right? A marketplace of financial institutions or financial services, pardon me. How did that platform kind of approach come in play, or a marketplace kind of play come in being? Did you think about it this way? Because your clientele had to be SMBs, I believe, at the time. I remember early reports saying SMBs and corporate were your customers.
great question. The market that we were after were, as you rightly said, small and medium businesses that then and even now form a very negligible small share of loan markets, bond markets, and securitization markets. We felt that so much had to be done to bring capital from India and internationally to such companies to enable debt and provide debt for growth, right? We felt that over the last decade and a half, ever since subprime, banking risk appetite and capital market risk appetite towards SMBs had sharply come down, right? And this was not changing because risk appetite was constantly being hampered by events like demonetization, events like the introduction of GST, RERA, the fall of ILNFS in 2018, COVID, and things are not changing. And therefore, we felt that that should be our core focus, and that would be the last bastion where there were literally no focused players at that time, right? Having said that, the problem statement was very large, right? India has more than 40,000 enterprises across the country that fall within this definition of SMB, right? For us to be able to address that problem meaningfully would require us to really rethink what the org structure should be, what the value proposition should be, and how we should go about it, right? So the reason we have three companies, in a nutshell, is because each company is tackling the same problem in a different way and jointly becoming a whole, right? So one company is essentially building our own understanding of credit by lending, which is Vivriti Capital, right? Another company is building a marketplace which can connect 2,000, 3,000, 5,000, 10,000 enterprises with various institutional and HNI investors to direct money towards these companies.
So
right?
demand and supply matching.
The demand and supply match, enabling price discovery, enabling credit discovery, making an incentive for both sides of the platform to come together and solving for transaction management, execution, monitoring. This is Credit Avenue, right? And the third company is seeking to use the credit history and the technology ability that we build to entice much larger international pools of capital to come onto Indian shores, right? And discover India performing credit, right? This is Vivriti Asset Management, right? So three companies. The problem statement is exactly the same. Mid-market India needs debt, right? But to achieve this in a much larger way at scale, three companies exist with very distinct value propositions and handling different problems.
Yeah, that's interesting. And also, before I moved out or my previous media stint, I also realized that you'd raised a lot of money, and I've been reading recent news. In total, you've raised about 165 million in total, right? It's a phenomenal approach, and it's testimony that in 4 years you've also gone and raised money. In 5 years, you've gone out and brought in some marquee investors. I want to bring that in. Your thoughts on that? How difficult was that? Did the previous stint with your previous corporates build your network, and therefore it was easy for you to get funding so quickly over the last 5 years? Or was it something that you had to build from scratch when you started up? You were all on your own and had to do this all by yourself?
So in reality, Vishal, I think we've raised more than $400 million now as a combination of what has come in Vivriti Capital and Credit Avenue put together. So around 195 in the parent entity and around $220 million in Credit Avenue. But this deluge has actually happened very recently. For the first 18 months of the company, we were bootstrapped, right? And that must have been the toughest phase of my of the last 20 years that I've worked, to manage a large team, build infrastructure, manage a client base, deliver products, build technology, lending capability, with just $2 million of equity that came in from my co-founder and myself.
So you had to manage technology, you had to manage people, and obviously you had to manage your, the debt delinquency or making sure that you get good people signing on the capital side of things, on the borrowing side of things. It must be hard.
It was hard because an early call that we took was that we should build infrastructure for scale.
Yeah.
Right. So very early on, we significantly invested in office space. We invested in people. We diluted around 22% of the company towards stock options for the team, even before the Series A. We developed our distribution and presence in at least 6 cities in India. We built a large technology team, right? And all this required us to keep the meter ticking in terms of business and revenues to ensure that we could pay the bills. So we are a company that has actually been profitable every year since inception. A discipline that has served us very well in the last 5 years to ensure that there is real commerce and value at the end of the rainbow, rather than just a promise of future value that we are seeing far.
So you're not just looking at the balance sheet size, but more of the quality of the products that you've launched and the people that have borrowed from you, right?
Absolutely. I think each business that we have set up, be it the platform business, the lending business, or the asset management business, it was important for us to deliver a certain value proposition very early, right? And ensure that there was significant buy-in from our clients in each business, right? So that genuine commerce was happening every single day, rather than just the promise of future commerce.
I want to move on to the next segment. I think I want to know what Nano Entrepreneurs means. You wanted a broad-based definition, and I definitely want to know that. Data says several things. People call them, micro entrepreneurs. Also, people also call them kirana stores or something in many ways. They call them micro farmers, micro this, micro that, many ways. But what is the segment nano entrepreneurs for you? And what are the products that you offer to these nano entrepreneurs?
So, what we do to simplify life is to kind of focus on the check size of borrowing as a way to differentiate between different categories of the market, because that's a good indication of size. So, let us say less than 3 lakhs of borrowing would be micro, 3 lakhs to 10 lakhs would be nano, and beyond 10 lakhs we get into a different segment that goes more towards small and then medium and so on, right? So if I had to kind of put this in the context of businesses, yes, kirana stores would fall in this definition, tailoring shops, right, food stalls, right, a host of micro ancillaries that could be at a tier 5 supplier to larger industries, for example. So manufacturing, services, trading, 99.9% would be sole proprietorships. They would not be incorporated companies, right? These would be setups where the household and the business merged in terms of balance sheet. There would not be a distinct balance sheet in that sense between the two. This would kind of be how you look at nano entrepreneurs.
Okay. And the type of products that you lend are short term for them, what they borrow for 3 months, 6 months, 18 months. I mean, how does the cycle work for them? When I was covering retail for the longest of time, most of them borrowed for working capital. And sometimes it was also for personal expenses like marriage, education. And so there's a whole gamut of loan products that, especially the big banks tried to cover them as the retail portfolio. But then they also burnt their fingers because there was a lot of delinquency. At least this is something I'm talking about. Between 2006 and 11, it was a burn for many of them. But was it because of the intent for these people not to be willing to be paying back, or was it that the product was structured badly for that segment? I'm thinking, what kind of products work? That is my actual question.
Yeah, so I think the product journey has really evolved over the last 15 years. In 2010, for example, when we saw lenders to the nano segment, the product was only term loans, right? And the reason was less to do with the intent of the lender or the need of the borrower, but more to with technology, right? A term loan is the simplest product to provide for a 3-year, 4-year, 5-year period with EMIs and a very straightforward way of accounting for money, collecting money, and managing customer experience, right? Over the last 15 years, what has changed is technology, right? Today, the breadth of products available to nano entrepreneurs is quite significant, right? One could lend against the receipts in their POS machine and provide them very short-term working capital, which is essentially revenue-based financing, right? One could lend money to them by way of off-balance sheet structures by leasing out their machinery, for example, right? One could finance them term finance against the growth that the enterprise would see, right? One could finance them purely against the value of the assets they hold rather than the cash flows, which is almost like a loan against property, right? Today, there are lenders who provide them very short-term working capital against highly realizable assets like investments or gold, and so on and so forth. So technology has made it possible for a wide variety of products to be offered to such nano entrepreneurs against their current business, future business, current cash flows, future cash flows, assets, etc., etc., etc.
And that's the model that Vivriti uses, right? These are the data points that you use at Vivriti for this segment too. It's direct and indirect lending also.
That's correct. So what we do is that we work with this segment through a series of partners, right? So Vivriti partners with more than 130 NBFCs today. Correct. That provide financing of various kinds, right? Some of them provide working capital, some of them provide term finance, some of them provide asset-backed lending, some of them provide revenue-based financing. Some of them, for example, finance the purchase of machinery, of trucks, of cars, etc., etc.
Something like a discounting?
Like a discounting,
okay,
or a leasing solution.
Okay.
And some of them just finance against finished goods and sale, right? Like a warehouse receipt finance, for example, right? Now, we partner with these NBFCs in fundamentally two ways. One way is to refinance this NBFC against their loans given to such nano entrepreneurs, enabling them to reach out more, build more branches, build more distribution, deepen their presence, and eventually build a business of lending to such nano entrepreneurs. The second way we do it is very interesting, where we enter into what's called a co-origination partnership, right? Where the NBFC might originate, let us say, 100 borrowers in Salem, right? Or in, for that matter,
I understand Salem well.
Colombo,
Yeah, Salem,
right?
Erode, that segment,
Perfect.
very entrepreneurial. Yeah, you keep it that way.
Perfect.
Yeah.
So in that segment, let us say there was an NBFC originating potential borrowers, right? They could lend 20% of a loan. Let us say for a loan of 5 lakhs, they would lend 1 lakh. Vivriti would lend 4 lakhs, right? But because Vivriti has a superior cost of debt, the effective cost of the overall 5 lakhs comes down, right? Which allows the NBFC to earn more, but the borrower to eventually get a better cost of capital and a more efficient cost of capital, right? Uh, so these are two ways in which we broadly engage with the nano entrepreneurial segment, right?
And the rates are customized. The interest rates are customized by the entrepreneur. They're very dynamic, or how do
They
they
are
work?
actually highly customized
Okay.
because the customer segments can vary quite widely from a risk perspective, right? As well as, for example, by tenor, by collateral provided, by other factors relating to the geography in which the loan is given, by cycle of business, etc., etc. So rates are customized. The end borrower rates can vary anywhere between 16% at the lower side to 26-27% on the higher side for a business loan.
Which is still better than the cost of capital in places like Salem and Erode. If you borrow privately, which is extremely high, they talk about 4% on the unorganized side. It is dangerous. It can go up to 50% per annum or something of that sort. And this is phenomenal. And you're able to do this because of technology tracking their receipts. Is there a way that the NBFC partners that you work with are able to gather that data and pass it back to you?
Absolutely. I think the advent of technology has made many, many such innovations possible, where at one level, the digital heat map of every single borrower can be gathered through public data and private data, where credit bureau score can be completely integrated with the credit model of the originator. The originator's decision to lend and KYC of the borrower, etc., could be completely integrated with Vivriti system, which means that there is a real-time funnel of borrowers hitting our platform, right? Flow of money can happen directly to the bank account of the ultimate borrower. This is possible through virtual accounts that are possible today in today's market, in today's technology environment. And similarly, collections from the borrower could also happen again similarly to a virtual account or an escrow to then get parceled to both parties, right? So this level of deep integration, tracking, and data management allows the partnership to function literally real time, right?
It's
So
almost
there
like
are
you had to get to know the sociology of these places that you go to, like Salem, Erode would have it, their own thinking vis-a-vis Chittur, or say Kanpur and all those places, right? Each of them would have their own nuances, community, the way they work. Because I was going down to the next question, which is what is stopping these nano entrepreneurs from finding NBFCs that have tied up with you, rather than going to the unorganized segment, right? It makes very catchy news. I know is that people on the other side charge high interest rates, but with such low rates this side, is it because the discovery process is very bad for these people? They don't know how to approach the right NBFCs, or they're so driven by family that they listen to family and friends and go borrow. Just to digress a little bit, because then I'll bring it back into how they repay and the maturity of these borrowers, things like that.
sure. I think we are in a phase over the last decade and a half or so where discovery is only increasing day by day. Usually, discovery is easier in urban markets, then moves to semi-urban, and then moves to rural. And I think we've been going through that for a while now. We have faced some roadblocks every single time the country goes through either macro crisis or a man-made crisis, so to speak. We face a roadblock and take 2 steps back, which is why there would still be large parts of the country that rely on informal borrowing than otherwise. There are also certain fundamental concerns that occur in certain parts of the country. For example, certain parts of the country are much more evolved in, for example, creating security, providing a legal cover to the lenders for them to have much more comfort on the structure. Land records are far better, asset records are far better, digitization is much higher, etc., versus other parts of the country, right? That inhibit lending in many ways, right? But certainly we have a very, very long way to go. So you're right. Many borrowers still continue to rely on informal sources of finance versus those that can actually access debt from NBFCs or small finance banks.
But that's the opportunity, right? In the short frame, how many nano entrepreneurs would have used your services through the NBFCs? Would you have data on that? And also some characteristics of, how is their repayment history? Let us look at the Salem region itself. How is the repayment history? How is the track record in terms of coming back, saying, okay, I'm going to build, are they building larger businesses? Are they becoming SMBs, nano entrepreneurs to SMBs to speak? Is that the progression, or is it that, okay, a tailor remains a tailor forever? Or is a tailor saying, okay, let me build a small retail outlet also? Is the progression happening?
Great questions. I think you had asked me about how we distinguish between borrowers at different parts of the country.
Yes.
And let's start there and move to how we see this growing. First and foremost, the more decision making in the lending business is manual and very specific to a region or a borrower, the slower we go, right? Significant innovation or rather development that happened around 10 years back was when the Reserve Bank of India introduced introduced much more competition into the credit bureau market, right? Pre 2010, CIBIL had a monopoly. Today, there are multiple credit bureaus in the country that are each jostling for a share of the pie, and therefore there has been significantly higher innovation in data science, in ability to manage large pools of data, in making sure that every bank, NBFC, small finance bank in the country reports to the bureaus. And as a result, the sheer development of high quality credit data has been phenomenal. As a result, a lender sitting in one part of the country can lend across the country, right? And has access to current credit information, past defaults, extent of indebtedness, nature of lenders, and a whole host of other information that was simply not possible, right? Similarly, the advent of GST has also made a difference. I think, however, that is more relevant for small and medium businesses and not so much for nano. But still, it makes a difference by way of being able to map transaction level information. The third is the advent of fintechs that have enabled analysis of bank statements, right? You would recall the Jan Dhan movement that took bank accounts to every corner of the country. The outcome of that was that banking transactions could now be measured, and fintechs developed that could digitize these statements and convert it to analysis for the lender to use at the click of a button, right? So between locating a borrower, which is Aadhaar, assessing a borrower through Jan Dhan, through bank accounts and GST, by understanding the past credit history of the borrower through credit bureaus, today lenders have maybe 20x as much information at their fingertips as opposed to 10 years back, right? Which has made the job of the lender in locating, assessing, and lending to a potential borrower a much easier job and a much more scalable proposition, right? Which is why today you see many fintechs picking up the challenge. Multiple payment organizations, let us say Apine Labs, for example, selling data of payments at the shop to a potential lender to be able to build a lending portfolio, right? these are the kind of technology integrations and partnerships that are making this space so exciting today, right? Having said that, I think COVID has been a period of reflection for pretty much every lender in this market, where borrowers had a very, very, very tough time in managing their business, meeting lender requirements, bringing their business back to speed after an extremely painful lockdowns across the country, as well as health considerations, right? And this has caused quite a this has caused quite a lot of issues for lenders in the nano segment.
Vineet, I agree with you. And so the behavior of these borrowers also is changing, right? Because of UPI and, like you mentioned, credit scores, credit history, the integration of Aadhaar, things are changing rapidly for this segment. So therefore, are these entrepreneurs looking to aspire to build bigger things? Like I said, the tailor to a retail shop. Is that something that you see progression in the next few years in this nano entrepreneur segment?
Good question. And I think we will always see progression happening from one segment to the other. Having said that, I think the vast majority is focused more on enabling the household to survive and thrive rather than grow the business. So we see both kinds. We definitely see borrowers being able to scale up, do much more, open larger outlets, or move into or set up larger manufacturing units over time, or build their access to the primary market to be able to sell directly, etc., etc. So, but we also see a very large part of the market, focusing more on their household's prosperity rather than the growth of the business itself.
Okay, on the delinquency levels, right? When I speak to bankers of yesteryear, they don't believe in this segment. They think banks cannot make money on this segment alone, and that there has to be some kind of priority sector lending on this. But you're giving us a complete different approach, saying that if we are data-led, if we track their ability to repay, and because they're so connected to local markets, there is cash flow. And if you can measure that cash flow, you see them repaying. I want you to throw lights on the delinquency rates actually in this country on an average basis. And going by numbers alone, would you say that betting on this segment, is it profitable in the long run? Or the short run, you cannot decide whether the segment works or not? I wanted your thoughts on this without talking about Vivriti, of course. I want it to be completely, on numbers on a macro level basis and not related to your company.
Sure. I think the nano segment has actually had a difficult time during the COVID phase. Pre-COVID, credit losses in secured and unsecured lending to the nano segment would perhaps be at 2 to 3%, right? Which is a very, very manageable number for a lender in the market, because interest rates of lending are relatively higher, and defaults can be priced into the cost of the debt itself, right? An event like COVID, however, kind of created a bit of a problem, because default rates started inching up to high single digits on a blended basis across these segments. The Reserve Bank of India intervened on a timely basis, and so did the government. There were two large initiatives very broadly. One was to permit a moratorium on repayment of debt for 6 months, which occurred in 2020. And the second was to provide liquidity that would be guaranteed by the government of India through various schemes. And these schemes were channelized through SIDBI as well as state-owned banks, right? Both of these served the purpose of controlling credit quality and helping the nano segment very well, I would say. And a large part of the credit for this must go to the government and to the Reserve Bank for managing this process well with lesser disruption.
So that's interesting, right? My question to you is that the policy is very good when it comes to this segment, right? So there is a very good support ecosystem. But what are some of the key measures that you recommend or would you want the segment to have? What are some of the key measures that the RBI or the government of India or the finance department should look at to have something for this segment? Should it be recognized as a priority lending segment again, or as a segment that has the potential to become the next level SMB?
I believe that the ability to get the right cost of liabilities is extremely important for business viability and for enabling more and more such lenders to grow. Right. My concern is that in the last 5 years, emergence of new NBFCs has slowed down. In one segment like consumer lending, it has shot up, but on micro enterprise and nano enterprise, the pace has really slowed. And I think more has to be done to encourage the formation of such NBFC that can be innovative on products, that can be innovative on the use of technology, on outreach, on risk appetite. Right. A lot can be done by way of providing very high quality refinancing support in the early days. Uh, a classic example is how the National Housing Bank has helped the emergence of home loan lenders, mortgage lenders in the early stage, right? Which enabled many such affordable home finance companies to grow. I think something similar can be done for the nano enterprise segment as well through refinancing support. The third is the emergence of capital markets and pooled investment vehicles that can bring in commercial capital through what we call blended finance structures, right? Where the government or a government-run agency, right, takes a subordinated position and allows commercial lenders to come in and understand the segment well, right? Now, what that does is that it allows commercial lenders to take a little less risk while providing necessary liquidity and eventually graduate to lend directly, right? The fourth is priority sector. I think this has been a bit of on off, on and off, on and off in the recent years. It was turned off in 2012, turned on after COVID, then turned off towards the end of last year, then again turned on a month ago. So it's been a bit on and off. I think there has to be some consistency in the approach that is taken, right? The fifth is, making networks like Oken much more prevalent and putting a much larger stamp on it, right? Because only through open data networks can we very significantly see these segments develop. The sixth is that credit history has to be shared between NBFCs and banks, right? Closing this out and keeping two separate networks between what the bureaus do and what Grillic does, I think is damaging. It's not helping the cause.
The black box approach does not work.
It does not work at all. Yeah. So I would say these are the few areas that can.
Okay. I always wondered with the UPI being around and, with a lot of the merchants in smaller towns using UPI as well. And, cash flow is understood, but still merchants don't seem to like credit cards, for their business expenses. Something like that should be allowed for NBFCs also, right? To issue credit cards to these merchants. I thought that would be a good start into creating credit also in a way. For larger loan products, if they want to expand, if the merchant wants to open 3-4 departmental stores within a tier 4 city, based on the area of number of villages that it covers or whatever, something like that should be done. But is that a possibility also, or is it just a pipe dream to say that no, we're not going to do that for a while?
No, what you said actually is very timely, and this is something the regulator has done very recently. The regulator has just opened up the ability for non-bank prepaid credit cards to exist. Having said that, I think the flaw in the approach that we see is that the regulator takes a licensing approach rather than a product approach, right? For example, if I want to lend, I would have to have a lending license. If I want to issue prepaid cards, I need to have a PPI license, and if I want to factor receivables, I need a factoring license, right? Now, if I want to be a comprehensive lender to this segment offering multiple products, I need to have 3 licenses, right? Which doesn't make sense because after all, these are products, right? So if we take a product approach rather than a licensing approach, that would make life so much simpler for the lender because the underlying risk is not very different.
I mean, I don't know, you must be speaking to places in Niti Aayog and things like that. They are talking platforms. I thought the UPI's foundation was to move into segments like the ones we just spoke about. But I think, like you said, it takes time, and licensing is something that has to go in a product and platforms era. is there an inherent fear in our bureaucracy, or is it an inherent fear in our political governance that what if it goes wrong? What is the sociology or the order there?
I think the inefficiency, so to speak, comes in on account of the lack of a unified approach, and sometimes a lot of things fall between the cracks, right? I don't think small NBFCs, for example, have a voice at the table, and I think that the much larger organizations are able to kind of make a far higher impact on the government, the bureaucracy, the regulator, rather than the small guys, right?
Yeah.
The second reason is that the intervention comes in from different parts. So, RBI, SEBI, Ministry of Finance, Niti Aayog, etc., and may not necessarily be coordinated in terms of the approach being taken, right? It's only recently that some amount of sandboxing has started to encourage innovation. A lot more can happen. I just think it needs a cohesive approach through a specific designated team that draws in from different parts of, as I said, MOF, RBI, SEBI, etc. And secondly, by giving much higher representation to last mile organizations.
I agree with you completely. And I just wanted to ask you, what is the relationship with the Michael and Susan Dell Foundation and Vivriti Capital? After that, we could talk about one more easy question. What are the books that you've been reading that you'd recommend to my audience?
Okay. The Michael and Susan Dell Foundation has invested in one of our blended finance products. This is a fund called Samarth Bond Fund that has provided long-term 6-year debt funding to small and medium-sized NBFCs that in turn finance nano entrepreneurs. So the ultimate use of proceeds is towards nano entrepreneurs. We aggregate high quality NBFCs that are able to locate such nano entrepreneurs. We finance them with the support of Michael and Susan Dell Foundation. The product is what is called a blended finance product, where impact capital comes in a subordinated capacity and allows larger commercial investors to come in. The larger commercial investors in this case being insurance companies, bank treasuries, HNIs, and financial institutions.
Okay. Is there a case also to securitize a lot of these asset products and being sold to global investors to take much more bets in the Indian market?
Yes.
Securitize? Yeah.
Oh, yes. That's a product that we're working on actively. MSTF is engaged with us on this product as well. We intend to create India's first retail asset securitization fund that is offered to international investors. A product that we are extremely passionate about. And we think it can actually make a significant difference in opening up Indian securitization to international capital.
Yeah, I look forward to the launch of that, and I'll follow that. And guys, I'll have Vineet back in again and talk more about that. But Vineet, that last question about the books that you recommend to our audience and any podcasts or that you follow to learn, or books that you read or art that you follow, your interests, please, before we close.
I try to keep my personal life a little away from my professional life to have more sanity in my life. So my interests in reading have been about discovering our history in the last few years, as well as going back to early Indian civilizations, as well as civilizations across the world. So not so much around business, really.
Brilliant. So you can talk to me about history. I love history. What is your favorite book on history, or any book that you've read on history?
Well, I've been reading a recent book by a guy called Graham Wright, who talks about extremely ancient civilizations that existed way beyond even the Indus Valley civilizations formed. Right? His theory is that India saw a global floods somewhere around the I would say 9th or 10th century BC that wiped out large parts of the world. In fact, he has found evidence across outside areas like Dwarka, Mahabalipuram, and so on, that show evidence of cities existing that are today 30 meters below the sea level. And if you wind the clock back by hundreds and thousands of years, they would actually be strips that are connecting India to other parts of Asia. And he has found similar evidence in Africa, in Europe, etc., etc. Fascinating book.
That's Graham Wright, right? Graham Wright is the right-wing WRIGHT.
That's right.
Brilliant, guys. Go check out Graham Wright. And this is Vineet Sukumar, of course, of Vivriti Capital. We'll have him on board again. We'll continue this series with Michael and Susan Dell Foundation. Thank you so much for being on theupstreamlife.com. We'll see you all soon.
Thank you for having me, Vishal. It was a pleasure.
Thank you, Vineet.